Well, good afternoon once again, ladies and gentlemen, and welcome to today's Power Options Open Forum Q&A session for this Friday, 1 week before the standard expiration. Of course, if you're trading weekly options, those did expire today, and next week will be the standard February expiration series. Well, I want to welcome you all to the presentation, and I want to encourage you to start typing in your questions if you have questions for today's presentation while we go through the brief introduction as some of the others join us in the room today. Well, my name is Mike Chupko. I'll be your presenter for this afternoon's presentation. I'm the Director of Education here at PowerOptions. PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors, and we do support over 23 different strategies, patented search tools, analysis tools, and the ability to track and manage those positions in the portfolio as well. I handle a lot of the coaching sessions and education. I just want to remind those of you that are currently on a trial, or for those of you that are subscribers as well, you want to make sure you take advantage of those free coaching sessions. Essentially a 40 to 50-minute phone conversation with myself. We'll walk you through the tools on the site, answer any questions that you have. Of course, I cannot give direct trading advice on any of your positions. We can walk through the math of adjustments and analyze positions if you're trying to set up a new strategy or help you set up the search parameters based on what you're looking for as well. I've co-authored 2 books on options investing with Ernie Zarreno, the president and founder of PowerOptions. I am versed in all strategies on the site. However, there are certain strategies I will not trade in my personal account, things such as naked calls, short straddles, short strangles, and iron butterflies. The strategies don't match my personal risk-reward tolerance, but of course if you have any questions about those, please feel free to ask them today. All right, the process and procedures for this afternoon's presentation. You want to use the question pod there to pose a question. Please feel free to ask as many questions as you want. We're slated to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, so about an hour. However, if we have questions that haven't been answered by the time we reach 5:30, we'll stay online a little bit extra and make sure we give everyone's question a fair amount of time. Questions, of course, can really be about anything. The tools on Power Options, some of the processes of radioactive trading, of course. You have questions about the Power Options applied service, and usually what we see is just general options strategy and education questions as well. Basic ground rules, don't be shy. Ask any questions that you want. This presentation is designed specifically for you to have an open and free forum to have your questions answered. There are no such thing as stupid questions, only stupid answers, so the responsibility is entirely on me. Please be patient. There may be a few questions ahead of yours, but as I mentioned, we will get through them all. And we encourage you to feel free to help us help others. If I'm answering a question that was posed by one of our attendees and your market experience or something that you've seen is slightly different, or you think that you want to make sure that I cover that, send that into the question pod and we'll cover that as well. Well, most important, it's the end of another week. Today, for those of us that were maybe in slightly bullish positions, today wasn't that great of a day, but you know, there's always another day tomorrow. So let's have some fun and get some education on our belts before we start the weekend. Now, for today's discussion, we are not going to do the regular search for weekly options. Usually how we start off the presentation is that we'll run a basic search in the naked put menu to see the total number of weekly options that are available. Well, we're not going to be able to run that search today simply because every stock, a security I should say, has an option that expires next week because it's a standard expiration cycle. Okay, so we'll just jump right into the questions, and then of course if there's no immediate questions, I'll just showcase some of the tools on the site as well. All right, speaking of the tools on the site, let's navigate over to Power Options here to our trial account. And we'll take a look at the first question that came in, and looks like David has a question. Please show me a long call search selecting the strikes and expiration. Well, David, that's kind of an interesting question. Of course, I can show the long call search, and to do that, make sure you have the long call tab selected. So click on long call here, and we'll go into search. But selecting the strikes and expiration, I can't tell you what strikes and which expiration to select. I have my thoughts on that, of course, of what I might look for, but that might be different from your goals and your expectations. You want to decide first, what are your goals and your expectations, okay? Now, anytime you open up a main search in a given strategy, we went to the default search here. We're talking about long calls, and what are we doing with the long call position? Well, we're buying a call, speculating that the stock's going to move up in price, and we're going to be able to hopefully realize a profit for the increase in the underlying stock price, all right? So, we want to look for bullish stocks. These default criteria are not recommendations or suggestions. It's just some basic starting points that Ernie and I have created to look for positions that we feel might have criteria that are essentially bullish. Well, to start off with, we are looking for stocks trading between $10 and $350 per share. Sometimes trading long calls on stocks that are under $10 per share. Well, if you're bullish on the stock, it's trading at $5. Maybe rather than buy a $5 call that's trading for $1.50 or $1, maybe you just want to buy the stock. That way it doesn't have an expiration and continue to move up in price. But again, that's personal preference. Earnings per share growth. We're looking for stocks that have grown 10% in earnings from last year to this year. A PE ratio of 0 to 70. A PEG ratio of less than 2. That's considered a common kind of criteria that's used. You want to use a PEG ratio of less than 2 for certain stocks. Looking for stocks that are not near the bottom of their 52-week trading range, and we're looking for stocks that have a broker recommendation of less than 2.1. Okay, and that's based on the ZAC scale, where 1 is a strong buy, 2 is a buy, 3 is a hold, 4 is a sell, and 5 is a strong sell. So we're really looking for positions that are only recommended as a buy or a strong buy. Okay. Now, as I scroll down further, we see here we're also using a very limited simple moving average. So we're looking for stocks where the stock price and the 20-day moving average is currently greater than the 50-day moving average. So we're looking for those positions that are currently in an uptrend as well. Now, to keep things simple, when you're buying calls, you typically don't want to buy a call that's a weekly option. You might not even want to buy a call that's just 30 days out in time. You want to give some time for the stock to move in your desired direction. Also, it is important to note that when you buy an option that's 5 months out of time, you're not paying 5 times the cost. All right. So most investors who buy calls or buy puts, they're buying options, that are maybe 5 months or more out in time. Now, if I'm selling premium, if I'm doing a naked put or covered call or bear call credit spreads, I want to give the stock the least amount of time possible to move against me. So I'm usually trading a weekly series or positions that are only 30 days out in time, for example. Okay. Now, right here, we're not allowing the strikes to go more. Just as a default, we're looking more for stocks that are trading right around at the money. So we're not looking for stocks that are more than 1 strike in the money. All right. And we're looking for deltas of 0.5 to 0.8. That also kind of works with the at or slightly in the money range as well. Option ask price, we're limiting it just to be less than $15. And looking for some liquidity, previous option volume greater than 0. Of course, you could input open interest as well. And as far as the Black-Scholes ratio, remember this is the actual trading price of the option divided by the theoretical worth. Well, we're looking for positions that have a Black-Scholes ratio less than 1.05, meaning they're only 5% overvalued or less, and they're undervalued to maybe as much, a maximum of 5% overvalued. Now, if you like to use other criteria, if you like to look for stocks that have a minimum average stock volume, or you want to look for stocks that have a higher beta, for example, maybe greater than 1, maybe greater than 1.5, you can implement that as well. Or if you use some of the technical indicators, RSI, for example, if you use that to identify stocks, or the Bollinger Band ranges, you could do that as well. It all kind of depends on what you're looking for. Now, David followed up as, what is initial value set versus other ways to sort them? Well, David, you can sort them any way you want to. Okay. Now, this search here, as you kind of should have been able to grasp as I was going over it, this is really based on some fundamental criteria. Stocks that have good earnings return, low PE ratio. You might even want to limit this. A common number I see when I talk to investors, they prefer to use a PE ratio of maybe 0 to 40 or 0 to 20 even. So you can restrict that as well. But this is more based on a fundamental criteria. Now, one of the other default searches is here is the Bollinger Band screen. This is another default search that was created using the Bollinger Band criteria that we have available. And you see here some of that stock criteria I just reviewed, such as the earnings per share growth, price to earnings, and PEG ratio is not here. We are, however, looking for stocks that are up near the higher end of their 52-week range, up near 60 or so. And the percent Bollinger Band range has to be greater than 95%. Now, if you're not familiar with Bollinger Bands, let's illustrate that very quickly. Let's just take the results here from the Bollinger Band. So this is using a specific search. Oh, it's still looking for stocks that are trading above their 20-day moving average as well. But this is focused more on using Bollinger Bands to identify stock positions as opposed to the fundamentals, which was available in the initial value set. Now, the Bollinger Bands, of course, let's go ahead and link to big charts here. We'll pull up some Bollinger Bands and we'll show you what you mean. I'm sorry, what we mean here. Okay, so this is just the static big chart without any upper-lower indicators selected. So I'm going to select some indicators here. I'm going to go ahead and select Bollinger Bands. I'm also going to see the SMA 20. I want to have that in there as well. And I'm going to shorten my time frame for this example. Let's put it to 6 months. Okay, so let's go ahead and draw a chart. Actually, let me shorten it a little bit more, make it a little bit more crisp. Let's go to 3 months, shall we? Fantastic. Okay. Now that minimum search requirement we were looking at in the Bollinger Band search, the %BB20, we were looking for a range of greater than 95. And what does that mean? Well, here are our Bollinger Bands. You have the upper band here, it's following along there, and here is our lower Bollinger Band. That filter for %BB20, if the stock is trading right at the upper band, okay, so if it's trading right here, which this stock particularly is, that means it's trading right at the top of its upper Bollinger Band. Some investors will use this, as you can see here. When last time it was trading in its upper Bollinger Band, when it breaks through, this is usually an indication of a breakthrough when it might be trading right at the upper band. Okay, so there's a little jump here from about 135 up to about 142, for example, 141, 142. Now, if our %BB20 was at 0, which is one of the default criteria that you will see if you use the Bollinger Band search for long puts, that means the stock's trading right at or near the bottom Bollinger Band. And yes, sometimes we see here, the stock was trading at that band, it actually moved up from there. But other times, you can also see the same thing where if it's trading right at the lower band, you might see a breakout. Now here it didn't do that. It hit the lower band and then it moved back up, hit the upper band, and then it moved back down. Well, there's some criteria that investors look for, specifically some flags when it's up at the upper band and it starts to move above it as to signify a breakout. Okay, so that's what the upper and lower Bollinger Bands are. And by the way, if you're trying to identify a stock that's maybe trading right around the mid-range of the Bollinger Band, maybe something for iron condors, you'd want to look for that %BB20 of maybe at around 40 to 60. Keep it kind of around 50%. Okay? All right, let me go ahead and close down big charts here. And that's just a brief description there of the differences between the initial value search, which is based more on fundamentals of the stock, looking for longer-term growth opportunities, versus the Bollinger Band default search, which is looking for stocks that are trading at a sort of a higher simple moving average, where the stocks have to be above their 20-day moving average, and where the stocks are trading right at the upper peak of that upper Bollinger Band. Now let's go back to the long call, the main long call home menu there. And when you go to the long call home menu and you scroll down, you see we have the long call learning center, and there's 2 tip sheets here, white papers, the optimized long option finder and Bollinger Bands for long options. So some of that information that I mentioned, where investors look for criteria when the stock's trading up near that upper Bollinger Band, and what kind of movement they're looking for when the stock's trading at that peak. You can read about it right there in the article. I'm not going to go through that whole article right now today, David, or any of you that are interested. But just go to the long call or the long put menu, and in the Learning Center you can link to that Bollinger Bands for long options. It's an article that Ernie wrote regarding the Bollinger Bands as well. Now, let's do a simple search based on some criteria. And actually, I'm not going to change them too much, because let me pause for a moment and let's say, okay, I'm interested in buying a long call. I'm interested in investing long calls. I don't do long calls personally. Sometimes I will, but I've never really had success with just long call trading. Go figure. But let's say that I was interested in buying long calls. What am I going to look for? Well, I'm going to keep it simple. Okay, so I'm going to scroll down to the bottom. I'm just going to hit clear these settings. Some of the settings I enter are going to be very similar to what was already there in the initial values. But I know if I'm trading a long call, what do I want to look for? Well, I know that I want to go farther out in time. I want to give time for the stock to move in my desired direction. So I'm probably going to want to be at least 90 days out in time, and I'll keep it under 300, for example. I'll keep it about a year out in time. Now, some investors like to speculate aggressively speculate with long calls. And what I mean by that is they like to buy deeper out-of-the-money calls, so they're only paying 10, 15, maybe 40 cents for the deep out-of-the-money call, even though it's far out in time. And their idea is, of course, if the stock does move up as they expected, they might be able to double their money. Well, if I'm doubling 10 cents to 20 cents, I'm not making a lot of profit, but I am doubling my money. The monetary price isn't that great, but we are doubling our money. I read an article several years ago that was out in a PDF form magazine called Options Trader Magazine, and there's a gentleman who teaches long calls who specifically buys about 20 to 30 different long calls per month. All of his long calls are at least 20% out of the money, and he usually doesn't like to pay more than 50 cents for any long call. He's expecting to be wrong 90% of the time. So 9 out of 10 times he expects his options to expire worthless. What he's hoping is that 1 out of 10 times the option that does gain will make enough profit to counter the other losses. Now, I don't like to do it that way. That's not the way I like to invest, and it takes a special investor to do that because they I'm sorry, because they you know, it's hard for an investor to assume they're going to be wrong 9 out of 10 times. Okay. All right. So I have to decide here. I might be willing to go as many as 2 or 3 strikes in the money. So I'll go show in the money, number of strikes blank to 3, and I may be willing to go as much as 2 strikes out of the money. So just I'll put 3 to 2 in the range. Now I'm going to have, of course, multiples on stocks since I'm using a wider range of strike prices. Not worried about the earnings dates. I'm not going to worry about the ex-dividend dates. As a general rule, for any strategy, Ernie and I suggest in the Naked Put book and the Protective Options Strategies book that for volume and open interest, you usually want to look for a volume 5 times the number of shares that you're planning on trading, and at least 10 times the number of shares, an open interest at least 10 times the number of shares. So if on average I find myself buying 5 contracts, I may want to look for an option volume today of greater than 25 and an open interest range of 50. Of course, that's just a guideline. A lot of investors I talk to prefer to look for open interest more in the greater than 500 range, maybe greater than 1,000. All right, the Black-Scholes ratio, well, if I'm buying options, I may want to be looking generally for undervalued options or options that aren't too overpriced, so I might keep that range of 1.05. And, you know, personal preference on the option ask price. How much am I willing to pay? Let's say I'm only willing to pay as most about $5 per contract. Now, all this other information, you can put that in as well. If you want to use implied volatility or the implied volatility range, you want to look for a specific delta, time value, bid-ask spread. Okay, that's also can be used as a measure of liquidity. Options that don't have a lot of open interest or volume will have a wider bid-ask spread. So maybe I want to limit my bid-ask spread to be less than 30 cents, for example. So just put that in as well. Now, that's just basic information that I'd look for. Some liquidity, my time frame, range of strikes, maximum price I'm willing to pay. Yeah, maybe I want to look for undervalued options and I don't want a wide bid-ask spread. What else? Well, stock price. Okay, we can keep that 10 to 350 or 10 to 500. That's, again, more of a personal preference line. Well, I want to look for stocks that have shown performance. They've shown growth and maybe have some good fundamentals. So, again, I'll probably use that earnings per share growth field again. Might use my PE ratio, 0 to 40. Okay, and average stock volume, I want to see good liquidity here. I want to see stocks that have average stock volume greater than 750,000 shares per day. I might keep that broker rec, but increase it a little bit to about less than 2.6. So still between a buy, strong buy, between a buy and a hold recommendation. I might want to see some movement on the stock, so I'm going to look for a beta of, maybe greater than 0.90. Beta, remember, is a measure of the stock's volatility compared to the volatility or the movement of the S&P 500 stocks. So a value of 1 means it kind of has the same volatility, same fluctuation as the S&P 500 stocks as well. So allowing it to go a little bit below that, but I want to look above that. But I probably don't want something that's too far out of bounds, so I'll limit it to be, less than 250. I could use Bollinger Bands if I wanted to, right? But first I'm just going to run a basic search. Remember, I'm going to look for stocks that are trading in an uptrend. So I'll just keep the basic one. I'm going to select stock price. Doesn't like that. Let me close this little pop-up here. Sorry about that. Let's try that again, shall we? There we go. Stock price to be greater than the SMA 50. Now, of course, if I wanted to look for stocks, if I followed the IBD listings or I followed Standard & Poor's, instead of using the stock criteria, I could just look for stocks in the IBD 50, IBD CanSlam, stocks in the S&P 100 list or the S&P 5-star groups or value line list as well. So I can screen specifically against those if I wanted to. But just with this basic criteria, let me go ahead and submit these settings. And I believe right now I'm just sorting by stock price, if I'm not mistaken. What are we sorting by? Let me check that first. Oh yeah, I'm sorting by stock price. Okay, so we narrowed this down to 289 results with those criteria, but that's probably going to be too many. And as I mentioned, you see there are some duplicates because I use a wider range of strike prices. So we have several options here in United Techs. August expiration, a couple different strikes. May expiration, a couple different strikes as well. Let's see, PPG Industries, they have some there. Parker Hannifin Corp. And so just a couple different ones there because of the different strike ranges and sometimes the different expiration month as well. Well, how would you want to sort it? Well, that depends on, what your personal preferences. Any of these criteria that you can use down below, you can use to sort your results. So if I did want to sort, let's say by highest earnings per share growth to lowest, just change that and click submit. So I'm telling the system rank them by the stocks that have shown the best growth in earnings from last year to this year. Okay, and it's so we still have the 289 results, but we've changed the order. Maybe if you wanted to sort by percentage to break even, or maybe you want to sort by bid-ask spread, and I don't know why you'd want to do that, but you could, of course. Or if you wanted to sort by Bollinger Band ranges, if you use the Bollinger Bands, you could do that as well. All right, so that's just some of the features there on the search, David, and some of the different criteria you can use based on what you're looking for there, how you can use the search and how you can change it. Okay, let's see here. Got a question from, is that Pat? Okay. Pat asks, I would like to see what various trades that you illustrate in the blueprint look like on a profit and loss chart and change the entries as you make them in the manual. Found that when I tried to do this, entered as a stock symbol at the present time. Oh, okay. So, Pat, you're going through the blueprint and you're looking at some of the historical examples and you want to see what a profit and loss chart would look like. Now, and of course you can't do that, well, you can't see it in that fashion on the profit and loss chart because it's not shown historically. When the profit and loss chart you're using the custom spread tool and PowerOptions is only looking at current options. But you can mimic that in a certain way. Let's see. No, I don't have one near me. Let's say that we were looking at an example on in the blueprint, let's say on a stock that was trading at $35, and Kurt did a specific income method number 6, when he entered the trade, okay, with different strikes. All right, so I'll just keep things simple. Let's go into the married put search. And this is just a broad example. Let's go to the default searches here, radioactive by EPSG. So I'm looking historically through the blueprint, and there's a stock price that was roughly around, let's say it was $36. So I'm going to limit this search real quick, and I'm just going to try to identify positions that are around the $34 to $38 range. Okay, there's one. SourceFire right now is at $34.47. But let's say you were looking at a historical example. I'm just going to throw out some numbers here. Now, let's say you were looking at a historical example where the blueprint was referencing a position that was opened at $35.50, and at the same time, a 40-strike put was purchased for, let's say, oh, I don't know, $35.50. Let's say $8.27 or $8.25. Okay. Well, I don't have that position here. But that's all right. I'm close to just the current stock price with $34.47. So here's what I'm going to do. Even though it wasn't SourceFire, that's quite all right. I'll go to the profit and loss chart on a current position that's near the stock price. Okay. And I'll just change the values. So in the blueprint, this particular position said the stock was opened at $35.50. And the 40 put, now let's say this is a September put, so it's 225 days out. Let's say that the example in the blueprint, the put option was only 4 months out. Well, okay, so instead of using the one that's 225 days out to expiration, I'll simulate just using a June put option on this particular stock, even though it's not related to the stock that's in the blueprint. I'm going to pop in my price of $8.25. Okay, so I can see now that when I enter this position, This has the same risk profile, essentially, that we would have had with the fake example we're talking about in the blueprint. Stock, regardless of where the current price is and what the current stock is, we've got stock at $35.50. We bought a 40 strike put about 4 months out in time for $825. So the total requirement was $4,375, guaranteed to get $4,000 back. So I'm only risking $375 or 8.6%. That math, those numbers would be the same, and the profit and loss chart would look the same. There might be some subtle difference on the halfway point here based on the current volatility of this option we're looking at compared to the volatility at the time of the other option that was talked about historically. Okay, now let's say that as time went on, roughly 4 weeks into the trade that Kurt's reviewing, that's being reviewed in the blueprint, that Kurt decided to use an income method number 6. The stock had moved up to 38, and he ended up selling the 1 month out 40 call for $1.50, and he bought the 45 for 40 cents. Okay? Okay, no problem. So just to look at how the math would look on that scenario, I'll just go back up and click on View Options, and I'll just choose March because it's about 1 month out, and I'm going to sell a 40 call and buy the 45. But because we waited for the stock to move up and the prices were different, we'll just simulate that. Okay, so I was able to sell the 40 call for $1.50, and the blueprint was saying that this example, the 45 call was bought 1 month out in time for 40 cents. All right, so let's go ahead and click Submit. And this is how that RPM would have looked now with that trade. The numbers are the same. Again, this curved red line might be a little bit different just based on some of the volatility on the options itself. But in general, this is the same risk profile that we would have seen. Now, I can tell you that most likely, just by looking at this particular income method number 6 trade we just showed, that Kurt probably wouldn't have done this. You know, we don't like to do the income method number 6 if there's still a little dip down here. We like to see that higher up and more positive. But that's just a walkthrough of how you can do it historically. Find a stock that's near the underlying trade price and just put in the numbers based on what you saw in the blueprint. And if you have a specific example, Pat, that you'd like to walk through, you can send it to us now, or you can just send us an email later. We'll try to walk you through it. Oh, that's right. I'm sorry, Pat. Yes, so in here, now that I've entered this RPM, of course, or sorry, I've entered this income method, what if partway between now and March expiration, what if the stock had moved up from where it is, with these numbers, of course, what if the stock had moved up to, let's say, $41 per share, March 17th, so let's choose March 8th. Okay, so we can see that the we'd have a loss on our short 40 call. The expected potential expected cost would be $207 to buy it back. We would have gained $550 on the stock, lost on the put, so the total gain here would have been $53. Again, that doesn't look like a good position, and I can say that we probably wouldn't have done this because of this little dip down here. We would have waited to see a different level on that if the stock moved up to $40 per share. And there's a pretty good example. Now let's say that on 3/8, let's say the stock's trading at 40 on 3/8. Let's run that real quick. Okay, so if we, I wasn't too far off now, was I? So let's say that the stock moved up to $40 on 3/8. Let's ignore the fact that we have the income method number 6 now. But if I was looking at this and I said, oh, well, if the stock did move up to about $40 on 3/8, theoretically, I could sell the March 40 call for $1.50. That's the theoretical price, the expected value, and it only would have cost me 21 cents to buy the March 45 call. That's interesting. Well, let's just change that now. So let's say I entered this position roughly maybe on March 8th after the stock moved up to 40. My theoretical price would have been $1.50 for the March call and 21 cents for the long call. Let's click Submit there. That's a little bit better. Not too bad. It's going a little bit into the red, but still, we just probably wouldn't want to see that there as well. So yes, you can evaluate the expected profit and loss there, Pat, based on the if the stock was trading at a certain price on a certain date. Oh, and Pat then follows up, the expected values are based on gamma, delta, time, etc. to calculate expected values. Oh, it's the Black-Scholes pricing model. Okay, so what it's calculating is using the Black-Scholes pricing model behind the scenes, and the Black-Scholes pricing model takes into account 5 factors: the stock price, the strike price of the option. We have two different, the expiration date. We have 2 different expiration dates here. We have the June put that we put in, of course, and the March option. So we've got the stock price, strike price, days remaining to expiration, current interest rates on the market, and then the implied volatility of the options, or the SIV of the options, the stock's implied volatility index. That's what's thrown into the Black-Scholes pricing model to calculate these values. So is it based on gamma, delta, and so forth? Well, in a sense, it's more along the lines of gamma, delta, and time. They sort of all use the Black-Scholes pricing model for those values. And do I do this prior to write a covered call or married puts? No, Pat, I don't actually. In general, I've been trading the married put techniques for 4 years. And in general, I find that I do stick to income method number 4s and income method number 6s. I rarely use income method number 1 because it can get you, I don't want to say it can get you into trouble, but you're capping the gain on the position. And if I got in the position expecting the stock to move up in price, then I don't want to sell a call that caps my gains. So yeah, I use 4 and 6. Occasionally I'll use 3. I will use 1. I mean, if you joined us last week or this week for any of the presentations, you saw that Silver Wheaton presentation that went out there, that we went ahead and used income method number 1 to do that. Okay, so where I'm getting at is I don't analyze what my projected income methods could be before I open a married put. Yeah, when I'm looking to open a married put, I come to the profit and loss chart and I run the what-if scenario to see, okay, what if the stock moved up 5 points within the next 20 days? I'm in the position. What if it dropped 5 points in the next 20 days? I kind of run the catastrophe report, as Kurt calls it here. But I don't simulate doing the different income methods because the income methods are going to present themselves if the stock moves up as I expected. I can use the portfolio tools, and we'll show that in just a minute after we cover some other questions by David on this topic that came in. But when I'm tracking the position in the portfolio, I can link to the position analysis view, and it'll show me the potential opportunities that are available based on the rules in the blueprint, and I can use that to simulate a trade before I do it. So I don't plan ahead and say, oh, I'm going to do income method number 4 if the stock moves up the 5% I was expecting in the first 30 days. Because when that does happen, an income method number 6 or an income method number 1 might be better. So I don't particularly plan for that in the sense that, well, if it does move up as I expected, I know there will be different opportunities that I can go through, and based on my SIGA model, my personal SIGA model for the conditions, my expectations going forward, and my personal goals, which are going to be different than yours, that'll help me determine what income method to use. Okay, so let me clear these out first and go back to just the straight married put. David had a question that came up when we first ran this screen, and he wanted to know why is the P&L at 4, 6, 12? Okay, well, when you're looking at the profit and loss chart, it doesn't matter any profit and loss chart, even if you're doing a covered call, for example. Even if you're doing a covered call, you'll see a blue hockey stick graph. This is your profit and loss at expiration. So this married put is saying if I held the position all the way to June expiration, made no adjustments, I'm going to need the stock to be trading at 43.75 right here, which is my break even. Again, that assumes I held the position all the way to June expiration and made no adjustments. Why was 416 selected? Well, it's the halfway point. What you're seeing when you first run the profit and loss chart, it's the halfway point between now and the expiration date, and that's what the curved red line is showing us as well. This is the halfway point. So halfway between today and June expiration is April 16th. Now, you notice that when I change that, let's go back and let's just add the income method number 1 here, simulate selling a March 40 call for $1.50. All right, so let's sell 1 call at $1.50 and hit submit. Well, we saw that our March expiration is going to be around the 18th. So now this changed to 2/29. Why? Because 2/29, February 29th, is halfway between now and the new nearest expiration. So I was looking at the nearest expiration, not the farthest. So February 29th is halfway between today and March expiration. So that's what this curved red line is showing us now. is what our total position would look like between the halfway point between now and March expiration. Okay. All right. Pat says, do you use the manual guidelines? I'm going to say a joke here, and it's not really a joke, but it's kind of funny. I might be the only person in the office that actually does trade by the strict rules that are written in the blueprint and doesn't deviate from them. I look to do my income method number ones when the stock is moved right to the strike price of the put option. Income method number 4, when the stock is moved up to the put strike price, that's when I usually sell to close the put and roll to a higher strike put. Ernie will typically wait longer. If the stock's moving up as he expected, if it goes to his put strike price, he'll let it go higher if the stock's continuing to move up. He might let it go 1 or 2 strikes out of the money and allow it to grow a little bit more before he uses income method number 4 or one of the other income methods. Kurt sometimes does tests in the Fusion account, and I'm not saying Kurt deviates from his techniques, but he likes to play around. He likes to say, okay, well, I've got this income method number 5 ratio call spread set up, but what if this time I changed it into a calendar? So the 2 options that I buy, or I'm sorry, the option that I buy is actually further out than the 2 I'm selling. I tend to stick specifically to the rules in the blueprint, and I typically look to do my income methods when the stock's trading right at the put strike price to maximize the advantage of the at-the-money bell curve. That's what I typically look to do. Okay, so David's follow-up question, is there a standard deviation metric for each stock for a certain period of time? Well, that's essentially what that probability equation is, David. Every time you run a search for the different options and you see there's a % probability above or % probability below, that's essentially taking the standard deviation of the 52-week trading range, for example, to apply a bell curve to determine where that would be, what would be the percentage of the probability, excuse me, based on one standard deviation. The stock would be trading above a certain strike price or below a certain strike price at expiration. Now, as far as the search tools, we do not have a filter that allows you to look for, let's say, long calls, for example, that are 1 standard deviation away from the stock price or 2 standard deviations away from the stock price. We simply use the number of strikes and the percentage in or out of the money. Okay. All right, so Pat, you had another question here, or a comment. This is your visual person, so graphing could help, and I just showed how you can use this profit and loss chart to do that. But let's say you're tracking a position. As we were talking about how you wanted to know, well, what could happen if the stock did X or the stock did Y, and okay, so for a new person, I understand how that can be beneficial. But when I'm tracking a position in my portfolio, this isn't the one I wanted. I wanted this one. Yep. Okay, so here's a position that actually has already been adjusted once, and we're looking at just a paper trade here on AFLAC. On 11/1, it's purchased around 39, and at the same time, a put option was purchased against it. We currently have the May 45 put that we cost $8.10, and it's trading down at $2.10. The stock's trading up at $48.33. But we did at one point during one of these webinars make a simulated adjustment or a paper trade adjustment, and I can see that because I did pay $39 for the stock, but my effective cost per share on the stock is now $37.14. So we lowered this by about $1.86. Now, but as I'm still tracking this position, what I'm going to do now is, okay, the stock has been moving up. What's available for me to do? Well, I'll go into the position actions menu and position analysis. Okay, and this shows me, okay, so with that one adjustment, we did manage to lower our risk to only 0.5%. That's where we stand right now in this position. We have a liquidation value of about 11.5%, and we have some available income methods here based on the rules in the blueprint. So we have income method number 1. Well, with the stock move up, I could sell a March 49 call for $1.13. And this would put me into a bulletproof status on this paper trade, a guaranteed profit of 2%. Okay, but does that match my goals and expectations? Well, let me take a look. So from this rollout, I'm going to go to Simulate Trade. All right, and this shows me the side-by-side comparison. There's a good view. My current position is on the left in red. I have a risk of 0.5% if the stock pulls back, and current return of 11.5%. And if I sell this call against it, the March 49 call, with the stock trading right now at about 48.33, will lower our cost basis. Our maximum risk is going to be negative 88, or minus 2%, so it's now bulletproof position, and the max return is 14%, and I can see that would occur if the stock was trading right at $49 on March expiration. Okay, so on the blue is what the new position would look like, on the red is the original position. Let's say that this stock has been on a good run, and my expectation is that Aflac might be trading up near $50 or $51 per share in the next 30 days or by March expiration. Would this really match my SIGA model if that was my expectation? No. I wouldn't want to sell a call at 49 if I'm expecting it to move up farther in price. So I might analyze the 50 call. I'm sorry, selling the March 50 call. I could simulate that one. Or I could look at the other opportunities. Okay, well, here's some other opportunities to use income method number 3. I could shorten the time frame of my option by selling to close my May put and buying a March put. Or we could use income method number 4, okay, to sort of ratchet up again to roll up that put. Or we could simulate an income method number 6. It would generate only about 34 cents of net credit, but it would still put us to bulletproof status. So if I want to generate some income on this position and get into bulletproof status, this is more along the lines of the income method number 6 kind of profit and loss chart we want to see once we've gotten into a position and we've allowed the stock to move up. So selling the 49 as we did before and buying the 50, well, in this case now if the stock does go up to 50 or higher, goes above 50, I still have an infinite profit and loss on the position, but I did generate a little bit of income against it to get it to bulletproof status. Sure, it's only $9 or 0.2%, but it's guaranteed. And of course, if this return that you have right now matches your goals and expectations at 11.5% liquidation value you have right now, you might just consider closing the position. It all comes down to the SIGA model for each of the income methods and the RPM itself. Have you met your goals? Now, we're also shown down here, and we can also take a look at this on the historical tools. The 2 positions down here in our history that are highlighted, these are the 2 positions I have open. And we see here that adjusted cost basis came from, we originally, at one point we sold a January 45 call. Oh, we did an income method number 6. We sold the January 45 call, we bought the January 46 call, and then we closed them out on January. Okay, we opened them 12/7, closed them at 127. We also rolled up the put at one time as well. Actually, we rolled it down. We had a May 50 put, and we rolled it down to the May 45 put at one point. So there was another income method that was done there as well. All right? But you can also see that back in the portfolio if I wanted to look at my historical trades. And I think this goes, if you programmed a spreadsheet to monitor changes in prices and option prices, you can add modifications. Well, that's kind of what this portfolio is doing. As I make changes or I make adjustments to the positions, whether I'm in a paper trade such as this or it's my actual trading account, I can take a look at the analysis view. And this is just on Aflac, so I can see what my all my positions were. If I need to go back and modify the premiums, or I'm paper trading, what if I would have done this, or what if I would have done that, then I can go back into historical reports, and I can always choose to add a closed transaction. All right, so I can simulate what would have happened had I done A or done B. And that's not showing it graphically, but again, you can kind of use that profit. Oh, I'm sorry, I didn't mean to go there. Let's go back to profit and loss portfolios. I can always use that custom spread tool, the profit and loss chart, to simulate what we were doing. Okay? Okay, I'm sorry, I'm just reading the next question. Okay, let's take that example. Okay, because your next question was, if you have a bulletproof position and a guaranteed profit, does this take into account buying back what is left on the call and the cost of the put? If you're just doing income method number 1s, Pat, you're kind of right. Right? It assumes that bulletproof status on the chart assumes that the call would expire worthless if the call expired worthless and you receive the entire premium. But that's what we show when you go to the, let's simulate that, for example, here. Position actions, position analysis. Remember, we had a 0.5%. I'm pretty sure it does, actually. I'm pretty sure it does take that account. But we only have 24 cents of risk here on this position now. Okay? So if I sell this call, what were we looking at? We were looking at the March 49 call for $1.13. Okay? So let's go ahead and compare that again with the Simulate Trade feature. So we have $24 at risk, and we're selling the call for $1.13. Okay? So This shows us a bulletproof status of 2 using income method number 1, 2%, or $88. But you're right, this $88 and 2% bulletproof assumes you keep the entire 113. Okay? Now, this is not projecting what if the stock was trading at this price on this day or this price on this day. I mean, the profit and loss chart kind of shows that, but this is based on expiration. Okay? What you're comparing is what would your current married put position look like on the left at March expiration, assuming liquidation on March expiration, and what would the profit and loss look like on the right? Again, at expiration, not any of the days in between. But once I add this position, do I want to do that? Yes, let's add it. Okay, let's go ahead and use this income method number 1. We're going to submit change to portfolio, add the income method number 1 to our position. Now, you're right. Today when I just opened this position, right now, we would receive $1.13. Of course, it's going to require $1.17 to buy it back. But what I can see now is if I go to position actions and position analysis, this current liquidation value, now that's still profit because of the large gain we've had in the stock. But if you click on details, this liquidation value on the profit and loss portfolio, when you see bulletproof, we're still bulletproof already essentially, but what it's showing you here is that it is taking into account the buyback cost of the call. All right, so for this current return, the liquidation return would be 11.7%. Now, is it possible from what you're saying, Pat, that I just bulletproofed a position by 0.2% when I just used income method number 1, and I buy back the call right now for 5 cents higher? Is it possible that that could be at a 0.1% loss? Depending on the bid-ask spread, maybe. But as time goes on, you only entered this position. You would have only entered this particular income method if your assumption was the stock was going to be trading right at or just below $49 in the next 30 days to match your expectation. All right, so that's a possibility that the buyback cost, if you're just slightly bulletproof, then it might do that. Oh, yeah, and Pat said, when I go to look for rollout opportunities, sometimes there's nothing shown or only one method. Perhaps the guideline might not have bet for rollouts over or only one managed system like income method number 1. Rarely do you get multiple methods. Yeah, in general, when you open the RPM, you want the stock to have moved up at least 5% from your original purchase price to see an opportunity for income method number 1. The income method number 4 opportunities really are best shown if the stock's trading right at or above the put strike price to maximize the at-the-money bell curve. So if I bought a stock and I bought a put that was 15% in the money and my total at risk was only, let's say, 6%. Well, if the stock has only moved up 5%, my option's still roughly 10% in the money at that point. So an income method number 1 opportunity might be calculated, but I might not see an income method number 4 because I want the stock to move up farther and be trading closer at the put strike price. And with the income method number 6, there's some guidelines in the background following what's written in the blueprint that you want a minimum net credit. I don't want to do an income method number 6. I'm only going to be getting 10 cents or 15 cents on the spread. So that's what we're looking at. Okay. Well, okay, Pat wants to know, are you writing an updated blueprint based on all that you have learned since last publication? We sort of bleed it out, and what I mean by that is Ernie and Kurt, when they start playing around with the new income methods or trying new ways of using income method number 4, as I mentioned that Ernie does, for previous blueprint owners, what they do is they post PDFs onto your free radioactive trading account. So any new updates, let's say you had blueprint number 9 and we're currently on blueprint number 10, you can download the PDFs for these significant updates between 9 and 10 by logging onto your free registration account or Fusion account at Radioactive Trading. So they're updating those as new techniques come out, as new thoughts come into play. I think between 9 and 10, Ernie did some mock-up on an update, I'm sorry, maybe it was between 8 and 9. I think it was between 8 and 9, edition 8 and edition 9. Ernie did some further discussion on using income method number 9 and combining a 9 and 1 when a stock has fallen in price. And I had an example of that too. So sometimes if the stock's fallen in price, you can link to the position analysis and you might see opportunities for income method number 9. But you also might see opportunities for income method number 9 combined with income method number 1. Okay? But yeah, those are available for you if you log on to your free registration account there as well. Okay, Larry, do you anticipate the real-time data to be streaming in the future? I don't think so. I don't know how frequently you trade, Larry. You've been to some of my presentations. You know how my trading style and sort of how often I trade. I don't know if the options really change that quickly for me to do that. Now, if you're trading weekly options and you're trying to get out of the weekly option that you sold or you bought for maybe a quick 10% gain and you're day trading the options, I can see why that would be useful. But for the normal strategies that most investors do, I don't really see the pure benefit of streaming real time with these kind of combinations. I could be wrong, but I just don't do that. That being said, I don't perceive of that. I know the programmers look at it from time to time and look at new modes of entering it and what the data costs are and how much that would have to be transferred over to our current subscribers. But for right now in the near term, I don't see that coming anytime soon. But whenever there's a new opportunity or a potential new data stream layer that we can use, we will look into it and we'll always try to break it down. But right now I don't see that coming soon. All right, Pat. And yeah, you're still digesting. That's great. Yeah, it takes some time to go through it, but I want to encourage you, to use the tools on PowerOptions and take advantage of those free coaching sessions if you have the time during the day. And we could talk about some of the ideas of maybe using that profit and loss chart to simulate some of the positions, or even using the Black-Scholes calculator if you're in a current married put and you want to know what happens if the stock moves up 5 to 10%. What would this at-the-money call be worth, or the March 40 call, or the April 40 call, what that might be priced at if I wanted to sell income method number 1. It's a little bit more manual process, but we can walk through that as well. Okay. David wants to say, please demonstrate various strategies for considering when plugging in a stock like Apple or IBM. Again, that's really personal preference. There's two ways to do it. Let's say I was interested in IBM, and to me, since IBM moves so slowly, there's probably only 2 positions I'm considering with IBM. That's me personally. IBM has a very low volatility, for example, so I'm probably not going to get anything out of a real good covered call trade or even maybe a naked put trade, for example. Bear call credits and bull put credit spreads might be difficult. This might be a good stock to do since it doesn't move as much, but the market knows that as well, so your premiums are going to be extremely low. So if I'm buying something like IBM that's a dividend-paying stock and has had good growth and is a very expansive company, I'm probably just thinking long-term growth with maybe married puts or maybe a long call position. Right? You also have to analyze if you're bullish or bearish. But again, if I wanted to look at a variety of strategies, let's type in the stock symbol here and click on Search Summary. The Search Summary tool shows you some basic positions that you might analyze on a given stock one at a time. And you see here I have some ideas such as covered call, bull call debit spread. Now let's take a look at the bull call debit spreads. It's a calendar call spread, I'm sorry. The bull put credit spreads here, the returns look good, it's 14, 15 cents, but the net credit, we're talking about 2 or 3 cents here. Is that worth it? A stock such as this. We are going far out of the money here for higher probability, but the stock's at 192, and actually that's not that too far to money. The stock's at 192, selling a 180 and buying a 175, or selling a 185 and a 175. Okay, 16 cents in net credit. This isn't really something you do a vertical spread on. Apple might be better to do a vertical spread on. You might do weeklies as well. But this is really going to come down to your personal risk-reward tolerance, David. You could use this tool to analyze, okay, what was my potential return for 1 month out covered calls at or slightly out of the money covered calls on IBM versus the bull put credit spread and the minimum net credit, or maybe a bull call debit spread. Long calls, of course, were in the wrong month. This just defaulted to February, but I would want to go further out if I was looking at married puts or long calls as well. And of course, depending on your sentiment of the stock, you can clear all, and then you can just select bullish, or we can select bearish, or you can select neutral. So that'll help you just kind of get an eyeball view of what is the risk rewards and the probabilities for different types of positions that you might want to enter. But I can't tell you really which position you would select. You have to decide that for yourself based on your personal goals for the position, what your sentiment is from the stock, and where you stand currently with your account. IBM, you hear me say this a lot of times in different webinars. When I'm opening married puts, I'm usually or married puts to the standard collars, I'm only looking at stocks that are under $50 or under $55 per share because of my account size. So I wouldn't even touch IBM right now unless I did it as a spread. But if I'm going to do something as a vertical spread, a leverage position, which I do with maybe about 15 to 20% of my trading capital, I'm usually keeping it to the ETFs and the indexes, for example, broad-based indexes and ETFs to sort of follow the pattern. All right. Let's see here. And then, of course, just as we do, we walk through on the search tools and so forth, now that, let's say I wanted to further investigate, this bull put credit spread, well, I take a look at the chart. I want to make sure that, the stock's moving in my desired direction if I'm interested in a bull put credit spread. I want to take a look at the company news. I always want to do that, whether I'm doing a search here or a search summary. I want to make sure that there's nothing out there about a potential buyout, a patent lawsuit, for example, CEO ousting, boardroom scandal. I just want to cover all my bases. And then I'll look at the profit and loss chart, just like we did with the other positions. I'll run my what-if scenarios. Okay, am I comfortable with what this position, this potential bull put would look like if IBM dropped 6 points or 8 points in the next 10 days, or if it moved up 8 points in the next 10 days? I'd want to simulate that. And then, of course, if we're talking about spreads, you might want to take a look at the midpoint spread chain to compare different things as well. So just do the further research and analysis there from the more information button. But the comparison of what's shown here, what's better, a calendar spread or a bull put credit spread or a bull call debit spread, there's no way that I can answer that, because that has to come down to your personal goals, your expectation of the stock, and of course your, I apologize, your risk threshold. Some of those leverage positions you might consider them too risky based on the risk reward. Okay, so this is a good place to start, and then if I want to see more opportunities, well, I've got some good bull puts here, but if I want to see more opportunities, I could always go to the search by symbol tools we did before and just compare those on the fly to different combinations of bull puts on IBM, for example. All right, Pat, follow-up. That's right. Okay, so the straight math, Pat, in bulletproof calculations, manual calculations, do not take into account the different expiration months. That's right. The profit and loss charts do. Does this create two situations that don't agree? No, not necessarily, because you are talking about two different things. When I first just do the math, and on the fusion positions, Kurt's open positions, we show this. If he does an income method number 1, we don't subtract that out of the percentage at risk until the position is closed, because you're absolutely right. So his active positions or Ernie's active positions that you're seeing, it doesn't show the position as bulletproof. If he had $1 at risk and he sold a call for $2, that's not going to show up as bulletproof yet. It's not going to show up until I actually close the call, because you're right. We don't know that we're going to receive that full $2. We might have to buy it back for $2.50, in which case the stock might have moved up further now, but we had to pay more to buy it back and actually added in some risk. But that would be okay, because in order for that to happen, the stock probably would have moved up $3, so it's okay to pay 50 cents back in to realize the $3 gain in the stock. So I don't think it's two things that aren't in agreement, Pat. It's just two different situations. One is looking at what is possible at expiration. The profit and loss chart is showing you what is possible at expiration, assuming the premium is collected, and then of course you have that one at the halfway point. Whereas the static calculation by hand is, if I had $1 at risk on this RPM and I sold a call for $2, am I guaranteed $1 bulletproof? Well, not necessarily. Okay, there's a slight difference there, and you're right, but it's just two different ways of looking at it. Because one, you're saying just static view. If I get to keep the full $2 at expiration, yeah, we would have taken our $1 at risk to being $1 bulletproof. But in the situation where we may have to buy it back, that's where the profit and loss chart comes in handy, because you can simulate that. What would happen if the stock did move up above, or 50 cents above my strike price of my short call in the next 10 days or 5 days? All right, Pat, do all of you have professional or full-time trader status with an IRA? Does your trading frequency provide enough trades to satisfy the IRA with the options? We're not registered investor advisors. We're not really considered professionals. I mean, Ernie trades more than I do. I'm very upfront with my customers. One of the main reasons why I trade the RPM techniques is simply because during the day, I don't have the time to watch positions. If I tried this before, I was trading iron condors on the indexes and different ETFs, and I had maybe 7 or 8 iron condors open at a time. I actually don't have the time during the day to watch that, to protect it, to maneuver it, and as much trading time as I need, because during the day, I'm typically on the phone. I mean, I had 5 different coaching sessions today and about 8 other phone calls as well, and various emails. Mostly during the day, I'm logged into a customer's account looking at their positions, discussing with them some of the opportunities that might be available, for example, and other things along those lines. So, yeah. I don't think we were registered professionals. I don't have a trading ID, but yes, I do trade the married put techniques in my IRA account, but I don't not consider professional status. Oh, no, no, no. Okay, so you're following that up, Pat, with a person's retired and is using trading as a hobby. You don't want to incur margin charge or do naked trades. There are no naked trades in the married put technique. Everything is covered by either the stock or the put option. You will never have to use margin if you follow the rules in the blueprint. All of the 10 different income methods are straight based on the stock and the put. Nothing is naked. Nothing is in there that will get you in trouble. Then that's right, Pat. Okay, following up on that, back to the portfolio, and we saw that. Let me see if I can pull that position back up again. All right, here's the AFLAC position, and you're right. We had an effective cost per share of 37.14 that we lowered from that income method number 6 adjustment we did and the income method number 9 trade. So our effective cost per share was adjusted down to 37.14. When we sold the call for 113, you're absolutely right. This hasn't been taken into account in the effective cost per share. Why? Because we haven't realized that yet. Just as you said, we don't know where we might have to buy that back. So we haven't realized the full 113 profit, so we're not going to state that our effective cost per share is 36.01 because we sold the call. Now that being said, when I go to the position analysis view, I didn't want to go to position analysis, so I apologize. If I go to the position profit and loss chart, let's go there. That's where I wanted to go. Okay, we go to the profit and loss chart now. This is taking into account my effective cost per share of 37.14. The 113 we collected, and the 810 we paid for the March 45 put. So what if I wanted to simulate what would happen if I had to buy back my call for $1.50? Okay, no problem. We've got the March 49 call sold. We'll go back into March 49 call. It says added, but I can click that again. All right, it was already said added, but I can click it again, and now it appears in our 4th line. So I'm going to simulate buying a March 49 call for $1. Let's put $1.63, not 163. Let's put $1.63, so 50 cents above what we sold it for. Click submit. Now that new profit and loss chart here, this is more of a representation. So you're right. See that? This takes into account that we sold this for $1.13, and we had to buy it back for $1.63. So I would have a risk of 1.6% still, because we had to add 50 cents back into the position. We took it into bulletproof status originally, remember? Assuming that that 113 was taken into account. But if I do add back in that I bought it back for 163, we would have taken it out of bulletproof status by that extra 50 cents we had to pay back into the position. Okay? So you can simulate that as well doing that. Yeah, oh, okay, I see what you mean, Pat, and no, yeah, I'm not registered as a professional trader, definitely. Okay, when David wanted to follow up, when I update my profit and loss summary, is the history of my trades compiled? Absolutely. There's 3 places you can see that. Let's go back to the profit and loss portfolio. Remember for AFLAC, as I'm rolling positions, as I buy to close options, and I sell to open new options, when we go to the position analysis screen, when you're evaluating the potential rollout opportunities or adjustments, okay, you can see the history of all your positions down here at the bottom. Okay, and if you wanted to see them by trade date, you could also go to historical reports as well, and that shows you all of the views by trade date. The ones that have NA, the 3 legs that have NA and gain or loss, those are the ones I have opened, unrealized gains right now. And then the analysis view, this is the one I prefer to use, it shows everything arranged by stock symbol. So if I just wanted to look at the past trades I've made in a position, I will go to the analysis view here. So for example, let me go to paper trading dividend covered calls, which we've done on our webinars. See all the different positions. Those that are in red are still open. Those that are in white are closed. So all of my craft positions have been closed. For PRU Prudential, we received 2 dividends. That's shown. When we put in our dividends, that's shown as well. And we have our stock long stock still open, but this was a covered call that we closed recently. So all of that's listed there in the analysis. View it by date in the historical, and when you go to the position analysis, you can see the history there as well, David. Okay. All right. All right, Pat, thanks for joining us. It was my pleasure to handle your questions, and I'm glad you got some useful information out of it. I think a lot of others did as well. Well, we're at 5:35 Eastern Time, ladies and gentlemen, so if you have any last-minute questions, go ahead and send those over. I'm going to navigate back over now to our slide presentation, and we'll just wrap up briefly. But if you have a last-minute question, go ahead and send that in. Just want to remind everyone, okay, those of you that are on your 14-day free trial, if you do subscribe to Power Options at the end of the 14-day free trial, you will receive an additional 14 days for free. So have use of Power Options for 1 full month before you're billed for the service. Now, the 20-minute delayed service gives you access to all the tools on the tool menu with 20-minute delayed quotes. That's only $60 per month. We do offer a real-time service. As Larry mentioned, it's not streaming real-time, but every time I run a search, refresh the page, I'm getting the numbers at that instant. So if I'm on a search page, I can hit the refresh button, basically every second to see the new numbers as it comes in. Well, the real-time is only $80 per month. And we do have an upgrade, the real-time plus historical, or what's sometimes referred to as the professional level of service, but you don't need to be a registered professional to trade it. That's $100 per month. And we also have discounted rates that are available for all different subscription levels as well for the annual subscriptions. All right, our upcoming webinar events every Tuesday and Thursday at 12 noon. Kurt hosts the Introduction to Radioactive Trading presentations. Every Wednesday at 12 noon, I typically host an Introduction to Power Options, essentially a 1-hour presentation on using the Power Options tools. And every Friday at 4:30 p.m. Eastern Time, we have our open forum Q&A. And remember, next week, of course, will be the open forum Q&A after expiration. Not that that means anything special, but if you have questions about your positions or how to adjust your positions or your paper trades in the portfolio after we hit expiration next week, join us next week, Friday at 4:30 p.m. Eastern Time, and we'll walk through that as well. And of course, if you access the Learning Center menu underneath the main Home tab at any time, you can access the archived webinars as well. The link's there, but it doesn't show up too well. So it's just powerop.com/webinars.asp. And then if you have any other questions, think of any questions later, just, you can contact us at any time. Send us an email to support@powerup.com. Call us toll-free during market hours at 877-992-7971, or if you live outside the continental U.S. at 302-992-7971. David wants to know, can I get option info over the weekend? Well, yes, the site's always up. You won't see price changes, of course, because the markets aren't open, but you can still run the searches and do all the information based on the closing prices of Friday. The closing price at 4 o'clock market time. So yeah, you can access the site at any time, and you'll just have the closing prices over the weekend. All the education is still there. Typically, Greg or myself checks the email off and on over the weekend as well. So if you send an email, you won't get as quick as response as you do during the week, but you'll still get a response in a timely fashion usually if you send us an email over the weekend with a question, for example. But yeah, the site is still open over the weekend, and you can still run searches. You can still do historical searches. You can still do everything you can on the site. It's just all going to be based on closing prices from Friday. All right, ladies and gentlemen, thank you very much for your time. Thank you for coming out this evening. We hope to see you next week for other free presentations, or perhaps on a coaching session. You want to schedule one of those? Take care, everyone. Have a great weekend, and have a good week going forward to expiration. Take care. Good night.